Welcome to Legacy Blueprint, Planet Forward, the podcast where top thought leaders in law, finance, and wealth planning come together to guide your future. Hosted by distinguished estate planning attorney Mike Bascom, each episode highlights industry experts who bring clarity, innovation, and proven strategies to the table. Because building a legacy isn't a solo act, it's the result of a team of professionals working in harmony. Join us weekly as we showcase the leaders shaping tomorrow and give you the tools to plan with confidence today.
Well, today we're joined by Samir Patel, managing partner at Trophy Point Capital, a private lending firm that's funded over $150 million in real estate deals while delivering consistent returns for investors. A West Point graduate, Army reservist, and real estate entrepreneur, Samir brings a unique blend of military leadership and business expertise to the world of financial planning and legacy building. Welcome, Samir.
Thanks so much, Mike. Glad to be here.
I understand you purchased your first hotel while you're still a junior at West Point. What drove you to make that leap so early in life?
I appreciate you did your research. I've always wanted to own assets. I learned very early on the idea of owning assets that produce cash flow. And for a simpleton like me, real estate was the only asset class that I could actually understand at that age. I wasn't going to start a software company. I wasn't going to, start a social media empire or anything like that. I had no competencies in that. But real estate was something that I gravitated toward, and I can understand it. It's tangible. And I think my bigger mission, even at that age, was I wanted to build assets that throw off cash flow more than anything else. And that's where I started.
How long did you keep that hotel, or do you still have it?
I bought it in 2007, right? Before the crisis, but I held on to it until 2017. So I held it for, full 10 years. The first 5 years I didn't make any money because 2008 happened, and surviving was a success in its own right. But after that, it turned out really well.
Well, it's always good to talk to someone who's lived through some of the ups and downs, because there's a lot of quote, gurus out there right now who have never seen a bad time. They don't know what a bad market is. So,
yeah, I teach real estate entrepreneurship at Georgia State University. And one of the things I try to do with my class, with my undergrad and master's class, my students, is try to dissuade them from the Instagram style version of entrepreneurship that they see all too often, the flashy side of it, the guys that probably even succeeded in raising a bunch of money. Anyone 2017 onward, I really have a hard time listening to, because they've lived in zero interest rate environments. They've never experienced what a downturn truly looks like and how ugly it can be. And they've never experienced what happens when you have leverage go against you. So I try to teach them some of these lessons. And you should only listen to people, I think, in my opinion, that have at least lived through at least one cycle and have experienced some pain, at least when it comes to real estate.
well, I think that's reasonable. It's interesting you combine your teaching, entrepreneurship, and military service. They're three very demanding callings. How do you feel like those have shaped your leadership style and your decision making?
I think they're all synonymous, actually, with one simple idea, which is get results. I'm typically most days a results-oriented type of person, and I like building teams as well. And so on one hand, I'm really lazy because I want other people to do the work, but on the other hand, I really like building teams and working through others, which is an enormous amount of work, as you probably know, having people on a team or on a staff. And I'm in love with the process. I think even if the money wasn't as great, or even if the economic output was not as large, I still would be in that activity of trying to get people together and trying to teach and stuff like that. And I also think that every true master of their profession should teach in some form or another. And I'm a big believer in that type of mastery as well.
That's interesting. I think a lot of people assume that military skills may not translate easily to real estate. And maybe easy is not the right word to say, but you've been able to translate it well. What lessons have you learned from commanding troops that maybe you've carried into running Trophy Point?
Real estate and the military at the core, and I'm biased, right? Some people would have different opinions, because I actually think my unpopular hot take is that a lot of military folks are not good for entrepreneurship in real estate, actually. But what I have zeroed in on is that this is a very people-oriented business, and it's also a finance business. And so People don't usually equate finance and military too often. But with finance, just to pick on that for a second, finance is also a risk mitigation exercise in many ways. You probably live it actually more than most through the clients that you work with. And the military is all about risk management in many ways as well, right? Conventionally, I was never a special operations guy. I was never like, anything really sexy or anything like that. But the general military, the conventional side of the house we're taught really well about risk mitigation, at least the principles of it. Now, do we employ it? That's a different story, but at least the principles of it. And I found that confluence really interesting to me. And I find like the activity the same, whether I'm working on a balance sheet or I'm working with, and I'm still in the reserves now, whether I'm planning even some sort of mini operation for the reserve job that I have. I think it's almost the same.
Excellent. Now, I understand that you guys have your company's funded more than $150 million in real estate loans and delivered very strong, consistent returns for your investors. What do you consider the secret sauce behind your firm's ability to consistently perform above market?
We just crossed a milestone actually. We just crossed 250 million actually of
Oh,
historical originated loans over the last 5 years. But the secret sauce is that we pride ourselves on being simple to work with. We focus on risk mitigation. It's the forefront of our minds. I'm actually the large individual investor in my own fund. The fund itself is about 100 million under management right now.
hmm,
I'm personally the largest investor. I take it personally when we lose money because our deal with our investors is that I have the first loss up
hmm.
to my entire equity before an investor's amount is touched. And I know you probably have some questions about generational wealth and stuff like that, which I appreciate. But I think if you're trying to build wealth, I think the first activity is not losing money more than anything else. It's not about hitting home runs or getting triples. I think it's getting easy singles and easy doubles. And lending is a great activity for that. And compounding at 8 to 10% is the game we play for us. And I actually like that game because I have my own money tied up in the fund. And I feel so convinced about what we're doing and how we're doing it that I'm willing to put myself in the crosshairs first before an investor loses money. But going back to the first part, I think being simple to work with is probably the most important aspect when it comes to the clients that want to borrow from us. And I tell our team, and we're about 35, 40 professionals now inside the Trophy Point Capital team, that great customer service is the best form of marketing because we haven't spent a single dollar actually on marketing for clients. Now we have spent a lot of money on trying to find investors, but for the borrowers that come to us, we haven't spent a single dollar on trying to find them. And it's all been word of mouth. It's all been referrals. And it all comes because my two partners, Dave and Nick, who actually run the operational side of the business, and they're my West Point classmates too. It's such a great experience for our borrowers that they just keep coming back. Even if we are more expensive, they still keep coming back because they know they're going to get a great experience and that we shoot straight and
Mhm.
we do what we say we're going to do. We don't retrade deals at the last second. We don't pull loans at the last second without any some real serious reasons why. And people, I think, get a great experience out of that. And that's why they keep coming back. And that's why we've originated 250 million over the last 5 years.
That's fantastic. I know private lending can be fairly intimidating to a lot of people. Can you break it down maybe in real simple terms, what it is and how it can benefit both real estate investors and families that are perhaps looking to diversify their portfolios?
Yeah, so most people in a real estate context, you have two general sources you can borrow from, if you didn't know that. Now, most people think it's the bank, and banks definitely do fund commercial deals or for-profit commercial investment activities as it pertains to real estate, especially. But when you talk about single family and lower end, like lower dollar deals, like $250,000 houses that you want to flip or buy a rental property with, the banks are a little bit more reticent to deal in that particular segment because it's typically an unstabilized property. It's a house in bad shape. A lot of money has to be put into it to fix it up. And then someone's going to try to sell it or refinance it or put a renter in there and refinance it. That's a long period of time, actually. Whereas banks typically like an asset that they can evaluate at a point in time. It's stable. It's not going to change. The use is not going to change dramatically. And they can underwrite that and they can make a loan on it. And then they often sell that loan off to somebody else and they trade loans back and forth. So that's the game the banks play, which doesn't actually lend itself well to single family and multifamily bridge lending, where people only need money for a short period of time. because it is an unstabilized asset, like I pointed to earlier. In that vein, the second option a real estate operator or investor could go to is a private group like ourselves. And there's many, many private groups, like hundreds actually across the country. Trophy Point may be a top 5% lender in terms of origination because we lend about 100 million a year. And that kind of puts us in the top five, definitely the top 10%. But there are private individuals, private families, even private groups, a group of friends even that form an LLC and just lend out of a checking account. We're all the same actually in that regard. And we typically offer more direct service. We typically have a much stronger grasp on real estate as well. Like I've flipped 20 houses myself when I was a lieutenant at Fort Lewis. So I understand the game all too well, and I know the pain points. Whereas a typical loan officer at a bank may have never even flipped a house. They may not even own commercial real estate themselves, right? If you knew what we knew, you probably wouldn't be working at a bank, to be honest. So there's a distinction there. Stabilize, go to the banks. If it's not, and you got to add value to it, go to a private group. And for families that are looking to diversify, ultimately, you got to find out what your goals are, which I'm sure you help your clients do. But for the majority of older families that may be already well established, there is definitely an argument to be made that 15, 20% of their portfolio, if not more, should be put in assets that throw off cash, right? So a loan, if you do it right, throws off monthly interest payments, right? Which is a steady stream of cash. And we send out, almost 700, 800 grand a month out the door to our investors through the interest payments that we collect from our 350 loan portfolio book that we have right now. Right now, some loans will go bad. It is part of the game that you will have defaults, you will have foreclosures. But by and large, if you're doing your job correctly, and which we think we are at Trophy Point, that steady cash flow at 8 to 10% is fantastic for many, many people.
I like that. You mentioned that sometimes the loan will go bad. I know that one of the models that you guys have at Trophy Point is safety and stability in an industry that's often seen as very risky. What do you do to achieve that level of dependability for your investors?
The central question we ask when we're making a loan or any investment decision, actually, but particularly for loans, is would I want to own this house myself if I had to take it over, right? So, and that's meaningful to us because me, David, Nick, we've owned 50 houses probably between all three of us. So we have a really strong grasp again of what we're getting into or getting involved with. And the central question is would we want to own this thing at the basis or the loan amount that we lend on? And the answer better be yes, right? It better be in a good neighborhood. It better be in a neighborhood with comparables of like-minded, not necessarily people, but like-minded assets or like similarly looking assets. We're not looking for opportunities where just because you put a golden bathtub in a house, you think it's going to be worth $1 million when all the other houses in that neighborhood trade for 300,000. Like we want to lend, 200 grand in a neighborhood where all the houses are 300. So if I have to own this house at 200, my exposure rate, then I know there's a significant margin of safety there where I can always fix it up, put a little bit of money into it, or pick up where the previous borrower left off and then sell it for 300 and make our money back. And we've done that 1,200 times in the last few years alone. And we've had to take back about 40 houses since then. But the interesting thing is we've actually made more money than we've lost. So some houses we may take a $10,000 haircut on when we have to fix it up and sell it. But other opportunities, we actually end up making more money. So, I don't want ever my clients to fail or my borrowers to fail because we're not in the business of trying to take back houses just because. But there is a weird sort of dynamic where you actually make money upon the foreclosure as long as you don't get into a habit of it.
Yeah, that sounds like it goes to your standards then as far as making sure that it's a safe project you're going into and you've got plenty of space there, cap space versus what your loan's going to be. As you're mentioning your example, 300, 200, $200,000 loan on a property that may sell for 300, provide some stability there. Very good.
Yeah.
So what are some of the biggest mistakes that you see new real estate entrepreneurs make when it comes to financing deals?
I teach a course on exactly this, a course to master students and to undergrad. And I will answer this question in a number of ways. And I may start off with the outcome first, to kind of paint this picture here. So most budding or new real estate entrepreneurs, you got to raise money, right? Real estate is a capital intensive enterprise. You just can't buy a house for 10 grand. It doesn't work that way. Maybe a tax lien, but you still got, other ancillary expenses when you do that type of activity. It's a really capital intensive exercise. Well, the problem is most new real estate entrepreneurs will hit up their loved ones first for money. Or in your case, you may appreciate this, they may hit up the family trust for some money that has been left to them from some previous generation or a parent. And the loved ones typically will give it to them because they love you and they want to support you and they want to support, activity, and they may even be excited for you. The problem is that new real estate entrepreneurs don't necessarily have all the risks in their head of what to mitigate for. They focus so much more on the upside that they don't consider the downside, and they don't put in plans or some thought into the downside risk. And I had a master's degree at commercial real estate from Georgia State as well. And I was lucky to have a professor who was an ex-banker at a fairly large bank. And, one of the things he trained into our head was, risk mitigation plans. And he calls it RIM analysis, which is identify the risk, what's the impact, and how are you going to mitigate it? And that RIM analysis now, it's just like in my head, I do it naturally. But a lot of entrepreneurs don't perform that type of analysis of identifying these risks, ranking and stacking and identifying the impact, right? So what if the main tenant leaves? What does that impact to the bottom line? Is it a 10% hit? Is it a 50% hit? 10% hit's not bad, but they don't realize that losing one tenant could literally be 50%. And then what are they going to do to mitigate it? Are they going to offer some freebies to get that tenant to stay longer term? Are they going to offer some tenant improvement, for example, to get the tenant to renew their lease? That's just an example, but that risk impact mitigation analysis, they don't do that often enough, and it ends up losing money. The deal ends up losing money for them, and worse, they end up losing money for their loved ones because they're typically the first group of people that fund new real estate entrepreneurs.
And you mentioned that you teach at Georgia State University a real estate entrepreneurship class. So, setting aside the newbies, what's a lesson you try to drive home to your students that you wish maybe more of the slightly more experienced entrepreneurs understood?
So if I were to write a biography now, it would probably be titled "It's Not About the Numbers," which, for the activity of real estate these days is largely an exercise in finance, actually. You've got a capital stack, you're going to borrow some money, you're going to raise some money, then you're going to put it into an asset. That asset's going to throw out rent, it's got expenses, it's got a bottom line, you've got to pay your bank back with debt service, and then you've got distributable cash flow. That activity I just said is like pretty much a whole semester's worth of knowledge right then and there by itself. And that is a very numbers intensive game. But you asked what's the lesson I try to drive home, and most students know that if they are a real estate focused major. But the lesson I try to drive home, it's not about the numbers in many ways, because if you can't raise the money, it doesn't matter how smart you are or how ornate and extensive your Excel spreadsheet or pro forma is coming to a deal. You've got to be able to raise the money. You've got to be a problem solver when it comes to dealing with tenants, maybe even with your own investors. You've got to be terrific at solving problems with the city or municipality if you are trying to do a zoning, sort of a rezoning effort, and some assets require that. Those have less to do with the numbers and everything to do about people and conflict management and being persuasive. I try to let them know that has to be accounted for in their careers. They may be great at the numbers and they may get a great job as an analyst, maybe, a senior associate, but they're not going to rise further than that in their careers if they don't have a healthy understanding that this is still a people-based business.
I like that. Someone wise said to me, every business is the people business.
Yeah.
There's a lot of truth to that one, I think.
And this may be I should mention this. So I just recently became a partner / majority owner of the Cialdini Institute. And you may have heard of Robert Cialdini. He wrote
Absolutely.
a book called Influence. And
Yeah.
so Robert asked me to take over the education arm of that business. And it's all about training and teaching people how to be more persuasive or how to implement the principles of influence, the 7 principles that Robert wrote about in his book, which sold 5 million copies, by the way. Teaching the principles of influence, obviously, but then helping clients apply it. And I was telling Robert, we met last week for a brainstorming session on where do we want to take this education arm of his business. And I said to him, every problem is an influence problem. Every problem is a persuasion problem when you get down to the core of it. It definitely is in politics. It definitely is with a spouse. It is with your kids. It's with a business partner. It's with convincing investors to invest in your deal. The numbers are part of it.
Mhm.
But like I said before, it's not just about the numbers. There's a whole nother game to entrepreneurship. And I'm so excited to partner with Robert and his wife, Bobette, on taking the Cialdini Institute to another level.
Well, I'm excited to see how that blossoms as well. Of course, Robert's very famous in the influence industry, not to be accused with the manipulation industry, which we seem to see a fair number of people who are in that business.
I'm
I'm
glad
excited
you,
to see where this goes.
I'm so glad you mentioned it actually, because we were talking about what are the pillars of this industry, of this company we're trying to grow. And Robert pointed out that it's the implementation of the ethical part of influence. And he told me straight up that his legacy isn't necessarily about the principles themselves, but it's the ethical application of those principles. And I think teaching ethical influence and spreading the message of ethical influence without the manipulation that you just alluded to, that I think is what's going to be the hallmark of this company, actually. Because lying to people, it's not good business. One, it's wrong, obviously, on its face, but it's also not good business because if you're trying to build an enduring business, whether you're in the wealth management space, you're in the trust and attorney space, you're in my business of lending money, people have got to be able to trust you. And they're going to know really quickly if you're manipulating. So it's really short-sighted of someone to just lie to a client to get some business up front, but then not be able to deliver it if they knowingly knew they could not deliver it.
Hmm. Yeah, I think sometimes those are short-term, maybe TikTok moment tips that people get on influence that actually end up being manipulative. So I'm excited to see what happens with you or leading the Cialdini Institute there.
Thank
Be
you.
excited to see what happens there. Now, so when you're working with investors and entrepreneurs, what's the biggest financial planning challenge you see them struggle with? And how does that risk holding them back from building lasting wealth or legacy?
I think part of it is not being clear on goals. I think most entrepreneurs that are successful are really good at making the money. That is a different and fundamentally different activity than maintaining the money. And you've probably heard dozens of stories of really wealthy scions. They made a lot of money, but then they don't manage it correctly, or maybe worse, they don't teach the kids how to properly maintain it and manage it. And I think that trips people up a lot. And I would hate to see, and I've seen it myself, like really successful families, and the old trope, the first generation establish it, the second generation makes it, and the third generation loses it. I've seen that play out time and time again, and I think that's where my teaching. I have a son now; he's 12 months old, so wealth planning and estate planning and legacy planning, all that stuff has kind of entered my mind a lot, especially over the last few months. And I don't think there's a clear discussion on goals, what the speculative money should be used for, what the lifestyle money should be used for, and then maybe what the other bucket of what do we want to pass on to the next generation? What do we want to do for that bucket of money? And there's not a clear plan around that. And so I know you'd probably do a great job of like explaining that to other people, but alpha go-getter type A entrepreneurs, they're really good at making it. They're not as good at planning it. And they think they know how to maintain it just because they're really good at making it. And they're two different activities.
We've seen that cycle repeat itself frequently. It can be devastating. You've built a wonderful career that spans investing, service, teaching. How do you personally think about a legacy, both for your family and the communities that you serve?
So I'm 39 right now, right? I'm about to hit 40. I don't, to be perfectly frank with you, I'm not sure I think about my legacy like that. I feel like if I don't have control over something, I'm not going to worry about it, right? In many ways, if you think about it, you don't have control over your legacy. It's based on what someone else thinks in their head about you. So I think I went through a period of time thinking like, what do I want my legacy to be? But one, I'm too young to think about that personally, I think. But I want to do good work while I'm here, right? And I want to get good results ethically in the way that I want to get it. So I think I'm just going to focus on that, and anyone else can form their opinion if I'm gone, what that legacy might be. I know you have a lot of questions on generational wealth, and I'll probably submit this unpopular opinion as well. I'm not sure building generational wealth should be a goal. I think, based on what I've seen and observed for myself on how money corrupts certain people
Mhm.
or how it warps the brain. I feel like you may be doing a disservice, not you, but I feel like leaving a bunch of money to kids may be a disservice to them because they don't fully develop on their own 2 feet. They don't understand what it's like to live in a ditch or experience real financial pain, which is obviously bad. But I think there's some character building moments that come from it. And if you're building just generational wealth without a plan behind it, or if the goal is just generational wealth and I want my descendants who I'll never meet to think positively of me, I don't think that's like worth spending a lot of time on. I think doing what you can now and maybe setting up a trust or estate plan where kids get a little bit, they have some safety net, but they can't not do anything. They can't afford not to do something. I think that may be part of my legacy if there is one. Because I don't want to rob my son of, frankly, I don't want to rob him of a little pain. I want his own conscience to develop. I want his own sense of decision making and his own style to develop in whatever way he feels. I don't want him tied to a family trust and he has to act and behave a certain way just because he's going to get a $5,000, $10,000, $50,000 check every month. I don't think that's serving him well, and I think it produces a terrible human overall.
So we check back with you in 10 years. We'll see you're
Yeah, you should check back. I mean, I
actively
talk a good
involved in the
game.
business, right?
Yeah, I mean, you totally should, right? Because it sounds great to me now saying it, but I'm still pretty young, so I'm
Well,
not the
no, I
right
think
person to be listened to.
investing in your child is such a smart thing to do. Get him those experiences where they struggle a little bit. It's okay. When you ride a bike, you got to fall down a couple of times and skin your knees. That's how you learn how to ride a bike.
Well, my father, my parents never bought me toys, frankly. Like any toys I got were largely gifts from others.
Hmm.
But they did buy me books, they did buy me experiences, right? And those two things and the emphasis on education, which is very common in especially Asian and Indian families, those two things are the best gifts that you could give anybody. And now I can buy my own toys should I see fit. So that's where I think the money is going to go.
Well, the other thing that success does for you is it allows you to introduce your children to like-minded and successful professional advisors and other people that you admire their skill set. So it'll help boost how quickly they can come up to speed on being successful if that's what they really want to do.
I agree. Yeah, I agree. I think toys for many kids, not all. I'm only a year into this parenting thing, so you probably know better. But I think like screen time and toys excessively, giving it to them excessively, prevents them from force finding social connections and building social connections as well.
So I know this year in my county, the schools have put a moratorium, no phones in classes. So that's I think a move down that channel. We'll see how it works.
I think it's a wonderful idea, right? Now, how you do it could be interesting, but think about it. Several generations of kids in America went to school with no phones already, right? And America turned out just fine for the most part. So I don't think it's going to be that catastrophic.
Many of our listeners are business owners who want to build generational wealth. From your vantage point, what role can private lending and real estate play in securing that kind of a financial future if someone's interested in growing one?
Like I said before, part of the game is not losing money. And you can put money in stocks, you can put money in angel investing, you can lend it to, or not lend it, but you can invest it in angel companies, startups. You could put it in private equity funds, things like that. You have a lot of options. But what I would suggest is focus on the not losing money first.
Hmm.
What are the if you're on that path, like the business owner path, and you've got growing wealth, the first question is, what can I do to not lose this money first? And private lending, because we secure, when we lend money on a house, on real estate, we have a lien to that property.
Hmm.
Right? So even if the loan fails, like the borrower fails to pay us our monthly interest payments, I still have title or the ability to secure the title, get the title away from the borrower, and then I can own it, also known as foreclosure.
Mhm.
The likelihood of that asset ever going to zero is infinitesimal. It's not even possible generally, unless you screw up title, but then you have title insurance. So you're not going to lose money, all of it at least, with the act of private lending, assuming you do it correctly and you do it with an attorney and all that stuff. Whereas you could put all your money into a startup, you could put all your money into a PE fund, and you could theoretically lose all your money, actually. Like they're in the business of leveraging your dollars and trying to hit you 15, 20% returns. And there's a part of your bucket that I think you should allocate to those types of investments for sure. But to answer your question about private lending and real estate, it is about the not losing part, which I think is the most important question you should be answering when you're devising a portfolio, if you've got a pile of money or at least a little bit of wealth.
I appreciate that. Sounds very, very sound. All right, last question and my favorite question to ask you. Looking ahead, let's look ahead. What excites you most about where real estate investing and private lending are headed in Georgia and beyond?
So we have a shortage of houses in this country. Now, depending on who you read or believe, we're short 3 to 5 million houses. And again, depending on who you believe, the average age of a house in America is between 30 and 40 years old. That does not bode well, actually, for the idea of home ownership and seemingly a growing population that we have, right? We're still growing at 2 to 3% a year. And I won't get into whether immigration matters or not. That's a different time, different podcast, maybe. We're not building enough houses as it is. So the only way we can reintroduce houses, aging houses, back into the supply is through what we do, through private lending. I think there's a lot of opportunity to revitalize old houses in bad shape and revitalize communities, actually. Not that I'm like Mother Teresa here, but I think from a opportunity standpoint, there are a lot of houses that need fixing. And there are a lot of older people that are unfortunately passing away. And those houses need to be put back online and upgraded and put back into the supply, functionally, that is. And we're at the forefront of that. And we have, 400 plus borrowers, 400 clients that are dedicated to the act of revitalizing houses, obviously for a profit, which I think is a great thing in by itself. And Georgia, like you said, or you mentioned Georgia. I don't think Georgia's immune to that. What I like about Georgia is that it's got population growth and it's got job growth. Population growth and job growth are the two main drivers of real estate assets, of values of real estate assets, right? You're talking about demand, raising value. Job growth and population growth are obviously the two biggest ones. So the southern states, especially, which is where we focus on, Georgia, Texas, the Carolinas, Tennessee. We don't lend in Florida because Florida's got some weird laws, lending laws, but the other states in the South are great laws for lending, great laws for business activity, and they've got job growth and population growth. So I'm really excited about that trajectory, at least for the next 5 to 10 years.
Well, that's fantastic. Quick follow-up question. Sometimes people ask, do interest rates matter?
They do, quite a bit. Now it matters in different ways to different people. So our republic, our Western way of doing capitalism is largely dependent on the credit cycle, right? And the credit cycle is extremely influenced by access to capital, which in turn is heavily influenced by the interest rate that the Federal Reserve targets. Do I think it should be independent? I think it should, actually. Do I think that the interest rates should be set in with regards to unemployment and inflation? Yes, I do think they should. Not necessarily for just juicing the economy at all times. I think there's an ebb and flow there. I will go as far as say that. But it affects people in different ways, right? If you're trying to buy a home, high interest rates will obviously be bad because you can buy less house. Like your salary is not going to increase dramatically. So the amount of money you have to buy a house is decreased when you have to make more of an interest payment, which has happened because of a higher interest rate. But for us in private lending, interest rates don't matter as much actually as you might think, because people are paying us a higher premium. They pay us a higher rate of interest, not so much of what Jerome Powell does, but more so because of the speed in which they're getting the capital and the problem we're solving for them. Because our guys are out there, they're making cash offer type deals to their sellers. And they're saying something like this: I notice your house is probably worth 105. I see you've maybe listed it at 105, 110. But if I close in 10 days, will you accept 90,000, 95,000? And there are many borrowers that will take that deal. No problem. In fact, many older borrowers or people that have deceased, actually, the heirs that take over that house that live 4 or 5 states away don't even care. They just want to, wind down the assets of their loved one. And if someone's coming along saying, hey, I'll offer you cash offer, I'll close, I'll guarantee the closing in 10 days, or you keep the earnest money. But would you give me a slight discount on it? You believe it or not, there are people, not all necessarily, but there is a segment of people, of sellers, that will take that deal all day long. And we support that activity as well. So the speed in which we create the value has nothing to do with, it is anchored to what interest rates happen in the Fed, but a lot of the premium that is paid has nothing to do with the Fed and more to do with the speed in which we're allowing our clients to borrow and get a deal done.
Yeah, good luck getting a bank to move in 10 days.
Yeah, I mean, we've closed deals sometimes in like 24 hours. If a previous lender dropped the ball at the last second and the title search has been done and some of the other documentation is already in place, we'll close deals in 24 hours. We've saved many, many deals from banks that dropped the ball at the last second.
Wow. We could talk forever on this. I love real estate. Many of our clients have real estate holdings. I appreciate you spending time talking with us today. If someone wanted to reach out to you, what's the best way for someone to contact you?
So you're always welcome to send me an email at samir@trophypointinvestment.com, trophypointinvestment.com. And then we also have trophypointcapital.com. And you're welcome to learn about our fund. All our documents are publicly available. The PPM, the audit, we're audited. The balance sheet, all my quarterly letters over the last 5 years are there for anyone's reading. You're welcome to take a look at all that. And I try to be as accessible as much as possible. So I'm only an email away.
Well, thank you again for your time. We will put those email addresses down in the description below. So if someone wants to check on those as well. Thank you again, Samir, for your time.
Appreciate it. Thank you so much for having me.
You bet.
That concludes today's episode of Legacy Blueprint, Plan It Forward with Mike Bascom. Each week, we bring you insights from thought leaders across law, finance, and wealth planning. Because building your legacy is never a one-person journey. It takes a team of dedicated professionals working in harmony to turn vision into achievement. If you're ready to take the next step toward your secure future, visit bascomlaw.com or call 77028559493. And don't forget to tune in again next week as we highlight more experts and strategies to help you plan it forward with confidence.